John Redwood.
Mr. Speaker, parliamentary colleagues, people from Wokingham, most important in my life, and ladies and gentlemen, thank you all for coming. And thank you, Mr. Speaker, for the great courtesy you've shown me in extending the invitation to give this lecture in such wonderful surroundings, and for your delightful introduction. I've often been introduced far less fulsomely than that, and I am deeply in your debt. And thank you also to all your staff who've made this lecture possible and do so much to make the workings of Parliament more successful for us all. The first argument I want to put to you today is that Parliament is at its best when we disagree about things, and that parliamentary scrutiny of government and economic policy doesn't work when consensus breaks out. Now, this is a challenging proposition to put in an age of coalition politics, and it is challenging to the spin doctors who assure me that the polling tells them that the public yearns for us to reach a consensus. Why can't the political parties go off in a private room somewhere, hammer out their arguments and come out with something that is clearly in the national interest that they can all agree about? I'm very pleased to say that the British public is rather more ambiguous in its views than this rather simple-minded belief in consensus from the pollsters would suggest. Because it is that same British public who, when they approach me or any one of my parliamentary colleagues to come to Parliament, always tell us they wish to come to Prime Minister's Question Time, which is the most tribal, the most brutal, the most ideological, the most conflict-ridden part of the parliamentary week. And if you say to them, but there are many good debates where we find consensus or where parliamentarians are in agreement, they say, no, we don't want to be palmed off with that. We want to see Parliament red in tooth and claw. We wish to see the disagreements between the parties. We wish to see leader of the governing party against the leader of the opposition to tease out the mettle of the men, and they have nearly always been men, or to tease out the significance of the issues. And it's that part of the British public's view, rather than their polling belief in consensus, that I wish to praise. Because the first two parts of my story tonight are about two major policy developments in the United Kingdom over the last 35 years, which have shown an outbreak of consensus and which have gone dreadfully wrong for the United Kingdom economy. And then I wish to finish on a third example of an economic policy which I think has on the whole been good for Britain, which was forged from ideological conflict, was bitterly contested by the leading opposition parties, but has now gone into the establishment view of how our economy should function and where the borders should be drawn between the public and private sectors in industry and commerce, the privatisation movement to which the Speaker kindly referred earlier. So the two great outbreaks of consensus I wish to examine are the experiment with the exchange rate mechanism and the more recent cross-party agreement that we need to have an independent central bank making large decisions on our behalf to create an economic stability that it is alleged would always escape the politicians with their more argumentative approach. And both these policies are really born of the same issue which dogged my earlier years in Parliament and dogged British approaches to economic policy. And it was born of the 1970s collapse and the difficult recovery in the 1980s. And it meant that many people in the economic establishment held the view that Germany had an extremely successful economy and that we needed to join with Germany, we needed to be more like Germany, we needed to follow those parts of the German remedy that could give us the stability, the low inflation, the faster growth, the reindustrialisation that the British parliamentary argument seemed to defeat. Now, who do I mean when I talk about the British economic establishment? Well, I mean some of the members of Parliament and government ministers. They come in and out of the establishment. But I mean primarily the people you don't see or hear about very much, the senior Treasury officials, the senior officials in the Bank of England, the Governor of the Bank of England for the time being, and the Deputy Governors, the policy groups who study the economy and often help fashion and agree with the consensus. Their forecasts nearly always go to a consensus view, and their attitude towards economic policy normally go to a consensus view. And this great economic establishment weighs down on incoming governments. Labour governments often fulminate against it because it tries to restrain them from spending too much or borrowing too much in the public sector. And free enterprise conservatives rail against it because it often constrains free enterprise conservatives from freeing as much as they might like, or from slimming the state in the ways that they might think appropriate but others would not agree. And on the whole, the economic establishment wins. On the whole, we proceed with rather minor changes. And a lot of the heat and light in Parliament over should we spend and borrow more is usually over a trivial sum of money, which would be a rounding error in the annual accounts. And so even today, an argument about 5 billion would be quite a big argument, and yet in an economy of 1.5 trillion, where public spending is 700 billion, it's not going to make a lot of difference one way or the other, whether the spending takes place or not. In terms of impact on the economy, it may be very important in terms of the particular programme and people who may benefit from it, but not for overall economic effect. And so this establishment has sought to achieve stability by averaging the ideological differences, by ignoring some of the ideology and making sure that it cannot get through to have much influence on policy, and constantly looking to these European models to see if they can make progress. And the first case, the exchange rate mechanism, was so obviously about that. And it was a policy that developed by stealth. Very curious that it did so, because it actually emerged under that great Chancellor Exchequer, Nigel Lawson, who I admire in many ways and who I think did on the whole a great job. But I cannot avoid a criticism tonight, because the one area where I found myself in disagreement with Nigel Lawson was over the decision to shift British economic policy from making British decisions about the British numbers to basing the possible stability, and as it turned out, massive instability of the British economy upon trying to get our currency to perform in line with the German one. Nigel Lawson had been an extremely innovative and forceful junior minister at the Treasury, and he had developed an independent monetary policy for the United Kingdom, which I think was very successful. It brought inflation down, and then it allowed us to have a reasonable growth record coming out of the rather brutal 79 to 81 recession. And so it was ironic that when he became Chancellor, I was looking to him to just carry on managing his monetary system, which I thought was working well, and to innovate in other fields, particularly in tax policy, where he did innovate and change a lot. But instead, I think the mercurial mind got bored with the success of the UK monetary policy, and he decided to shift, in line with very strong advice from the economic establishment at the time, to shadowing the Deutschmark, the then German currency. And I first intercepted this process when I was Margaret Thatcher's policy advisor, and it was the only issue where I think I found myself at variance in private, and didn't let any of it get into the press, with the Chancellor, because it's never a comfortable position when the senior advisor of the Prime Minister is in disagreement with the Chancellor. Alan Walters found that out and lost his job over going public over it. And it places the Prime Minister in a very difficult position if her principal advisor is at loggerheads with her Chancellor, who is in many ways her more senior principal advisor, as well as being holder of a great office of state. But I felt I had to point out to her that we were starting to shift our monetary management and our general economic management from the tried and tested controlling our own money, which is exactly what Germany did. They control their own money with targets, to this proxy, because the British establishment really did believe that the Germans had been so much better at it in the past that if we just linked into that German system through the currency, all would go well. And I remember writing memos explaining how it couldn't conceivably work. And then after I left the government, I published a pamphlet explaining that if we did join the exchange rate mechanism, one of two things would happen. We would either join at a rate of the pound to the Deutschmark, which meant that the pound wanted to go up, and in that case we would have to create a large number of pounds and sell them over the exchanges to try and keep the value of the pound down. And this would be very inflationary, and we would have a very nasty inflationary boom on our hands. If, in contrast, we chose to go in at a rate which was too high, the reverse would happen, and we would have to buy in pounds over the exchanges, and this would take all the liquidity and cash out of our system. It would be rather like throwing banknotes away, and it would give us a very nasty recession. Now, the British economic establishment knew better, and they said, oh, no, you're too pessimistic. We will find the perfect rate, Mr. Redwood, and we will go in at the perfect rate, and we will create this wonderful stability. I was quite sure there was no perfect rate, and I was quite sure that if they happened to strike it lucky and choose the right rate for stability on day one, within 3 months or 6 months, because the British and German economies were very different and performing in different ways, the rate would cease to be the right rate, and then one or other of these things would kick in. Well, I was wrong, because, of course, what joining the exchange rate mechanism did was not either create an inflationary boom or create a nasty recession. It did both. And what we got was a pretty sharp inflationary boom while we were still shadowing the Deutschmark, because sure enough, we joined at too low a rate. They created loads of pounds. All this money found its way into the bank.